Today's lesson is on investment risk. And there's really, in my book, on page 71 in the workbook, there's a graph and a chart, and we've put that up on the board today. There's 5 different types of risk that you choose to take on your portfolio and your investments. And what we've done on this graph is we've gone through the different 5 types of risk that there is and then evaluated them for each possible investment that you could make that make up an investment portfolio. So today's focus is going to be on market risk, really is the stock market, and talking about what happened back in March where we had a severe decline in the stock market. And what we want to educate you on and share with you is what you can do about your risk exposure. So if we look at market risk, I mean, the risk in the market is you take risks as just to get a return. So, stocks are going to be where most people have their risky money. And to the extent that you were invested in stocks and then the level of risk within those stocks is according to how much money you lost back in March. So we can't do anything about that now, but we're going to talk a bit about what you can do to prepare your whole investment portfolio for the whole of your retirement. So when we go down the list here of choices and what you can invest in, actually I'm going to get over on this side. So we talked about stocks and equities. The market risk is very high. So when in good times, they're going to go up and you're going to earn a substantial return. In the bad times, you're going to possibly lose your money quickly. Now, the other 2 high ones on here are gold and commodities. I mean, they tend to work inversely with the stock market, so this is a safe haven, but there's still a lot of risk in owning gold or buying gold futures. It's a different kind of market that creates losses in that. And then options. Options just generally in any markets, they're going to carry a high risk, and many of the seniors that we work with as clients have no business involved in these. Now, that's not all the seniors, but many of them. Now, what we're going to talk about here is some of the investments that really carry low risk, and that's bonds. And bonds have traditionally been used to offset and moderate stocks. So you have a percentage of your portfolio in bonds or fixed interest devices, and then that's going to moderate that. We got fixed indexed annuities, and what annuities can do is provide you some part of the market return, but yet protect you against losses. Fixed rate annuities are just where they're going to pay you a stated interest rate. Bank CDs, which many of those are at very low interest rates now, but yet they're safe. Your principal is safe and it's guaranteed by the FDIC. And so this is going to be a place where you're going to have no market risk. Same with cash and money market accounts. They're going to guarantee the principal. And then real estate. Real estate is of a moderate risk. You can certainly lose money on real estate. You can lose it to expenses of maintenance and then the liquidity, which is over here. But what my suggestion and where I find most people or where we try to get them is to a point where they have a mixture of a number of these things, all designed to moderate the amount of money that they have in the stock market, or some people have gotten out of it altogether. So we're really not on here today to give investment recommendations. I just want to begin your education on really understanding risks that you are taking and then helping you find the appropriate amount. We'll be glad to help you with this. I'm Hans Scheil, and I thank you for listening.